Hey guys, welcome back to the Independent Investor Channel. My name is Ryan, coming to you from New York City, New York. This is the fundamental question in investing, when to buy, sell, or hold. This came up on some comments, and I'm going to make a video that goes more in depth on my philosophy on buy, sell, or hold. And by the end of this video, guys, you should really kind of put a lot of misconceptions to bed with regard to when it is that you buy a stock, when it is that you sell a stock, and when you should hold that asset, all right? So please enjoy. This is gonna be one of the most important videos that I come out with on one of the key aspects of investing, really one of the fundamental pillars to investing, all right? Now keep in mind, guys, the Independent Investor Channel is all about getting you folks enthusiastic about the market, okay? Now, if you are a non-investor out there, your decision is already made for you, okay? Having the option to either buy a stock, sell a stock, or hold a stock is by nature of the decision that you made to become an investor in the first place, all right? So pat yourself on the back, all right? A lot of people make this a lot more difficult than it has to be, and I'm here to simplify it because my approach to buying, selling, and holding stock is actually very, very simple, and there's a lot more fundamental involved with how I approach the market, okay? And it has a lot to do with where you are in your investing career, okay? Are you at the beginning stages, or you are at the middle stages, or are you approaching maybe retirement, okay? Any one of those three stages can really help answer the question of when to buy, hold, and sell a stock. Okay, guys, it's really, really simple. There's not a cookie cutter approach to doing this. A lot of folks want to employ a cookie cutter strategy, and they want to employ stop losses into their program, and they're very, very disciplined and regimented. And I'm not saying that that's wrong or right. I'm going to tell you it's probably not in line with my philosophy because I want an open palette. I want to have the flexibility and maneuverability to do whatever I want when I want. And that's really what I talk about when I'm talking about empowering new investors, is getting you involved in the right account to allow that maneuverability within those accounts, guys, all right? So point number one on when to buy, sell, or hold is what type of investor are you, okay? I've split up my investing community. If you're in between $0 invested or a beginning investor, and you've got $50,000, okay, invested, if you're $0 to $50,000, then you need to approach the market in kind of a similar manner, okay? Now, I know there's a lot of different styles out there, but the one that I gravitate to for those people who are in between that particular range of investment dollars, you guys really should be long in nature. And what it means to be long a stock basically is that you enter into that asset with the intention of holding it long term, okay? I know Warren Buffett plays a scenario that if you had to buy a stock tomorrow and then you were going to get put into jail for 10 years, would you be willing to come out of jail in 10 years and be happy with the stock purchase that you made? And it makes a lot of sense, guys. And I approach investing when I'm going to buy a security or buy a stock or buy a certain index fund or ETF, I want to make sure that number one, I'm prepared to take that into a downturn, okay? Because I'm going to dispel a notion for you guys. If you think that you're going to buy the perfect stock and it's just going to go up every day, I've got news for you. The majority of the stock purchases that I make, they end up going down first. And that's just the nature of it, all right? It's something that you just have to kind of weather, and the way that you can weather it or buffer that decision is to make sure that you're putting yourself into quality assets that you don't mind taking into a downturn, okay? Now, the short positions that I'm talking about really need to occur once you've been a passive, long-term investor first. All right. I just had one of my viewers tell me that they've started their self-managed Roth IRA account and they put themselves into the ETF VOO, which is the Vanguard's S&P 500 index fund, or excuse me, ETF fund, phenomenal fund, and their first stock purchase was Apple. I couldn't have built it any other way. But when you're first starting, your goal in each one of those assets should be long-term. All right. Don't catch a market downturn in a month and then come and want to beat me up because because I don't know what I'm talking about with investing, all right? I'm recommending those assets to be in your account for the long term. I mean, even greater than decades. Really, you could almost purchase those assets with the intent of keeping them indefinitely, all right? And that's what it means. So many people think that they need to go in there and retool their investment accounts every day. And that's just not the case. I understand that I advocate for the self-managed investor on the Independent Investor channel, and you absolutely have the capability to go in there and fine-tune your product every time. And I think a lot of the discipline comes with understanding that power, but not acting upon it, all right? So that's long versus short. And anybody in that $0 to $50,000 range with that much capital in investing, honestly, guys, you should be putting yourself into long positions within those accounts, all right? Now, those long positions that we're putting into that account, all right, we need to be setting up on two different buy structures, okay? The first one is dollar cost averaging, okay? The phenomenon of dollar cost averaging is basically taking an allocation of dollars that go into that account once every month or once every 2 weeks, all right? Now, with a managed institution, guys, they're gonna charge you for dollar cost averaging, and they're gonna charge you for the dividend reinvestment program, all right? They're gonna charge you to do that. In the self-managed program, we don't charge on either one of these two programs. Now, the dollar cost averaging doesn't necessarily have to be on the 15th of every month, all right? Listen up here, because this is a secret from my repertoire on how I strategically buy, and I don't actually do a set dollar cost average. I only buy stock in the red, okay? And I'm more apt to buy when the market has come down 100, 200, and even 300 points on, let's say, the Dow Jones Industrial. Let's just say we're having a severe red day, all right? In a dollar cost average program, that's gonna buy systematically on the 15th, no matter what. And that's how a managed institution is gonna set it up for you. The way that you can do it as a self-managed investor, let's say the 15th has an up day of 150 points on the Dow. Let's say the 16th has a market correction of, let's say, 250 points. I would rather see you strategically buy on the 16th than I would see you go ahead and dollar cost average, right, on the 15th. All right? I call it strategic buying, okay? It's really simple, where I adjust my buy points in my good quality stocks on a down day. And I think historically, over time, that's really going to accelerate my growth going forward, all right? Now, the dividend reinvestment program, that's very simple. That's where you put these quality names within your stock portfolio, and you're setting up those stocks to take and pay you the quarterly dividends, but then to reinvest it back into the stock, guys. If you haven't kind of tuned into the theme here in the first 3 talking points, if you are an investor that is just starting out in the market, your entire goal should be to accumulate shares. That's it. Your goal should be accumulate shares. Now, by the nature of buying the asset, okay, you've taken that critical step in becoming an investor, and you're also holding that asset because you've set up these programs here. You're already doing 2 out of the 3 of when to buy, sell, or hold, all right? Now, buying and holding, honestly, guys, that should be your wheelhouse all the time. If you're a beginning investor and you're young, the only thing that you need to be thinking about is share accumulation. That's it. You need to be building these up through a DRIP and a DCA as quickly as you can, and you need to be accumulating those shares for the future, all right? Because when we're looking to take withdrawals later on in life, which is really why we're investing in the first place, the Independent Investor channel, I don't advocate for investing to be able to put food on the table, okay? Those dollars are separate, and it's a different discussion for a different day, all right? These are monies that we're gonna put into a retirement account that we can tax protect. That way, when it comes time to withdraw time, the IRS isn't stepping in and taking their money, and then wealth preserving that money going forward. Again, so money managers aren't stepping in and taking their fair share, all right? I want all the profits to go to you guys, all right? Now, the last thing here, I touch on it in every video that I make, and that's the account type, all right? comparatively speaking to Robinhood, all right, and there's a lot of channels out there that talk about Robinhood, and I'm not down on Robinhood at all, but Robinhood used correctly is a very disruptive, very good application to give you direct market exposure, all right? It's a form of self-managed investing, therefore I can advocate it, but if you're not careful, all right, you are going to enter into taxable situations. And that's why Nate O'Brien talks about using Robinhood in the correct manner, okay, and using it as a platform to enter into long quality positions and keeping them for the long term. Okay, that's how you use it correctly. I just fear that a lot of people are starting the Robinhood account and trading in and out of positions 100, 150 times over the course of a year, and each of those are generating tax situations, okay? We want to be very careful of that. Now, the self-managed Roth IRA account that I advocate for provides you the tax protection and the wealth preservation within those accounts to put those passive positions in place to allow for the dollar cost averaging to be set up free of charge, allow for the dividend reinvestment program to be set up free of charge to you, and allow those dollars to grow tax protected and wealth preserved going forward. And that way, when we're basically putting ourselves in a position to realize a sell someday. Okay, now I'm going to be coming out with part 2 of buy, sell, and hold, and we're going to be talking much more about the sell side of it. But from 0 to 50, guys, I want you to be looking at entering into the positions. You can monitor those positions, but the worst mistake I ever made in my investing career was hitting the sell button. Okay, it's one of the worst mistakes I've made. All right, that's why we're not talking about it. When we're a beginning investor, you guys should be looking at buying and holding. That's it. All right, we'll look at selling down the line, or when you get those assets built up from 0 to 50, then we can start to enter into some of these short positions to trade around a core, or perhaps even introduce some swing trading within your account to try to accelerate our profits even forward. All right, thank you so much, guys, for tuning in to the when to buy, sell, or hold segment of the Independent Investor channel. If you have not subscribed to the channel, please do so you're notified of any future videos that I put online. Leave your commentary at the bottom. If I've missed something on the buy, sell, or hold side, please leave your comments at the bottom. I review those in depth. And please share this information with anybody out there that you know can benefit from the information, friends, family out there that are looking to get more information on the stock market. Guys, thank you so much for tuning in. Good luck in your investment future.